Ladies and gentlemen, John here, and I need you to stop scrolling right now. Because what I am about to show you could mean that the silver coins sitting in your safe at this very moment are not worth what you think they are worth. Not even close. It is March 18th, 2026, and a silent collapse is happening inside the global silver market that mainstream media refuses to touch. The spot price says one number, the COMEX says another, the Shanghai vaults are screaming a third, and the coin in your hand might be valued by a system that is breaking down in real time. Silver crashed from around $80 on March 8th to $67.85 by March 22nd, according to USA Gold's daily price history. A brutal slide in just 2 weeks. But here is what they are not telling you. While the paper price was dropping, the COMEX registered silver inventory hit a record low of roughly 80 million ounces, against more than 400 million ounces of open contract obligations. That is 5 paper claims for every single ounce of real silver, 5 owners, 1 coin. Now look at your coin again. This is John Funds AG, and in the next few minutes I will expose 3 things that will change how you look at every silver coin you own. Number 1, the hidden mechanism that decouples paper silver from physical silver and why your coin sits in the gap. Number 2, the exact data showing that some silver coins are now valued at far less than the silver inside them. Number 3, the action plan that protects what you already own before this gap closes violently. This is not hype. This is not panic. This is the silver market in March 2026 as documented by Reuters, Kitco, JP Morgan, the Silver Institute, and RealClearMarkets. Now hold on, because here is where it gets dangerous. For 15 consecutive months through early 2026, RealClearMarkets reports that physical silver has been leaving COMEX warehouses at volumes the exchange has never processed. 15 months of nonstop drainage. Predict.io reports. COMEX registered inventory hit a record low of about 80 million ounces against more than 400 million ounces of contract obligations heading into the March 2026 delivery cycle. Kitco's February 12th report confirmed it. Significant withdrawals signaling a structural shift in the global silver market as physical demand challenges Western pricing. Read that line again. Physical demand is challenging Western pricing. That means the paper price your coin dealer quotes you, the spot price on Kitco, the COMEX last trade. Those numbers are being overruled by what's actually happening with real metal. So if the paper price is broken, then what is your silver coin actually worth? This is where the trap begins. Look at this carefully. The Silver Britannia in the UK, legal tender, £2 face value, capital gains tax-free. The American Silver Eagle, legal tender, $1 face value, subject to up to 28% collectible federal tax. The Silver Maple Leaf, $5 Canadian face value, legal tender of Canada. Each of these coins has a face value that is laughably below the metal value. A 1-ounce silver coin with a $1 face value, holding nearly $70 of silver at March 2026 prices. If the pricing system breaks down, what number wins? The face value, or the spot value. The system says spot value, but the system is the thing breaking. This is the detail nobody is talking about. Now think about this logically. JP Morgan Global Research forecasts silver averaging $81 per ounce in 2026, more than double the 2025 average. The Silver Institute's World Silver Survey 2026 confirms record industrial demand from electric vehicles, solar panels, and AI infrastructure. Reuters reports the global silver market deficit will widen to 46.3 million ounces in 2026, the 6th straight year of supply falling short of demand. The fundamentals are bullish, aggressively bullish, but the paper price crashed almost 20% in 2 weeks of March. How is that possible? This is the question nobody's asking. But the answer is sitting in the data. Look at the lease rates. TradingKey reports that by January 2026, 1-month silver lease rates exploded from a normal 0.3 to 0.5% to roughly 8%. Bullion Exchanges documented elevated lease rates in the 6 to 7% range in short tenors, with brief spikes higher during February tightness. Facebook commodity analysts and LinkedIn institutional desks reported London silver lease rates that normally trade 0.3 to 0.5%, hitting 8%. These are not normal numbers. These are panic numbers. Lease rates this high mean physical silver is scarce. Holders are demanding massive premiums to even temporarily lend metal. The borrowing market for real silver is screaming distress, while the paper market shows a crash. That contradiction is the trap. This is where it gets worse. The US Mint suspended all sales of its silver numismatic products on January 14, 2026, citing extreme volatility in silver prices. The official government mint of the United States shut down. The Perth Mint reported volatility-defined March markets, selling 976,450 ounces of silver in minted product form during March 2026 alone, almost 1 million ounces in a single month. The world's largest mints are either pausing sales or struggling to keep up. Now think about what that means for the coin in your safe. If the mints cannot keep producing, the coin already in your hand is rarer than the paper market admits. But here's the part nobody noticed. Silver flipped into backwardation in 2026. Multiple market reports confirmed it. The futures curve inverted, spot trading higher than near-term futures. Backwardation is not normal. It is a panic signal. It means the market is paying a premium to get physical silver right now instead of waiting. When backwardation deepens, it means real metal is so scarce that the future is being priced lower than the present. And the consequence of this backwardation, combined with 8% lease rates, is that the entire COMEX pricing mechanism is under stress. This is the second layer of the trap. Now look at what March 2026 actually delivered. Per RealClearMarkets and Predict.io, March 2026 became a definitive stress test for the global financial system's handling of physical commodities. Registered silver inventory hit record lows. Contracts standing for delivery hit unprecedented levels. Backwardation persisted. Lease rates remained elevated, and in the middle of this stress test, the paper price slid from $80 on March 8th to $67.85 by March 22nd. Does that look like a normal market correction? Or does that look like coordinated paper selling against a backdrop of physical scarcity? This is the question, and the data is the answer. Now I need you to see this carefully, because here is where your specific coins enter the story. If you own American Silver Eagles purchased at 15 to 25% premium and the paper price drops 20%, your coin's market value can fall further than the silver inside it. The metal stays the same, but the premium can compress violently in a falling market. Generic silver rounds, junk silver, Britannias. These typically hold their premium structure better in volatility because the premium is closer to spot to begin with. The higher the premium you paid, the more vulnerable your coin is to paper price destruction in the short term. This is how average stackers get crushed. They pay 22% above spot during a rally, then watch silver drop 20%. And suddenly their coin is worth less than what they paid. Even though the underlying metal narrative is more bullish than ever, the coin did not lose value, the premium did. But you only see one number on your dealer's buyback screen. That is the trap. And it gets worse. Look at the global picture. China has been quietly accumulating silver while the West sells paper. Reports from multiple precious metals desks indicate Chinese demand for physical silver continues to climb while Western paper inventories drain. If the world's largest silver consumers and largest mining nations are taking physical delivery while Western retail panic sells paper, who do you think wins this game? One side holds metal. The other side holds promises. When the system stress tests fully, only one side gets paid. Now stack the global facts. 6th consecutive year of structural deficit. 46.3 million ounce widening gap in 2026 per Reuters. JP Morgan target of $81 average for 2026. COMEX registered inventory at record lows. Silver flipped into backwardation in multiple windows of 2025 and 2026. Lease rates spiking from 0.5% to 8%. U.S. Mint suspending numismatic silver sales in January 2026. Perth Mint reporting volatility defines March markets. Every single one of these data points is bullish for physical silver. Every single one of these data points is a warning that the paper pricing system is breaking. And yet retail keeps watching the spot number and selling into the dip. This is how systems collapse, quietly and suddenly. So what does this mean for you? Right now, today, March 18th, 2026. Here is your action stack. First, know what you actually own. Audit your premium, audit your tax treatment, audit your liquidity. Second, diversify your silver across multiple coin types. Junk silver for divisibility, Britannias and Philharmonics for low premium, Eagles only for liquidity, not stacking weight. Third, watch the COMEX March delivery cycle, watch lease rates, watch backwardation. These three signals will tell you when paper price suppression breaks. Fourth, stop measuring your stack by dollar value alone. Measure it in ounces, because ounces are what survive a system reset. Now lock these 4 insights in. 1. Your silver coins are not worthless, but the paper system pricing them is breaking down in real time. 2. The structural deficit, the lease rate spike, the backwardation, the vault drain, all confirm physical silver is scarce while paper silver is abundant. 3. The premium you paid matters as much as the metal itself in a volatile paper-driven crash. 4. The fundamentals are the strongest they have been in modern silver market history. Per Reuters, per JP Morgan, per the Silver Institute. If you want me to track the March 2026 delivery cycle and signal the exact moment the paper system cracks, hit subscribe right now, smash that like button. Drop a comment with the silver coins you are holding. I will never ask for your money. I will never sell you signals. I will never run a paid course. just real data, real sources, real silver. Because the paper price says your coins are dropping. The empty vaults say your coins are rare. The lease rates say physical silver is scarce. And the system that decides which side wins is breaking down in front of your eyes. Your silver coins are not worthless, but the system pricing them might be. This is John Funds AG. Watch the vaults. Trust the metal. Question the paper. Because the next move in silver will not be decided by the screen. It will be decided by who is still holding real ounces when the music stops.